Hey there. So today we're going to talk about basic charting. So first, just go to Investagrams.com, and once you're here, you will arrive at the landing page seeing our features, okay? So in this website, we have different tools that can help you with your trades. And if you want to practice, there's also virtual trading. But first, let's focus on the charts, okay? So just make an account first if you haven't. Log in. You can log in with Facebook. And once you're in there, you're going to arrive at your main social media page. So there's a social media within the site. So you can see the analysis of other traders as well. So we can learn together in this manner, share our insights, stuff like that. And you can put on your notes here. So anyway, moving forward, let's go to the charts. So just go click this app button and then you'll see the charts here. So you're going to arrive at our charts. It's just loading a bit. So here. So what do we make out of these charts? For those who aren't familiar yet, basically in a chart you see the behavior of the price in the previous history. So historical price behavior. So you also see volume here. So we're tracking how the stock behaved in the past. So the notion of technical analysis of chart studying is that by studying the past behavior of a stock, you get a stronger feel of its future direction. Okay, got that? So what are some concepts that are essential with stock picking? With chart studying. All right, so I'll introduce to you the concept of support and resistance. Oops. So today we're going to discuss support and resistance. Some people think that this is really basic, but actually if you really understand the basics, it would suffice as a tool to help you make money. If you understand support and resistance, you can actually make money already in the markets. So what do I mean by that? What do I mean by that? I'll show you some examples. So let's look for a certain stock where we can apply support and resistance. Okay. So when we talk about support and resistance, it represents the supply and demand, okay? So when you observe certain price behaviors, you're going to see that at certain levels, stocks would bounce, okay? So this is what you call the support level here. So this is PPC, and if we observe it, every time it goes near 260, it bounces up, right? So here, it's able to hold the level 260. And then every time it bounces off 260, every time it goes to 290 to 3, you can see that. You can observe the behavior. What happens? It bounces again, goes down, right? So if you're a typical trader, this is what you call range trading. So just by knowing support and resistance, you can profit from this cycle. So here, if you buy every time PPC hits 260, sell it at 290, that's 11%. So that's a good 10% run, and it happened a couple of times in this phase, right? So not bad. And if we were able to sell at a higher level, that would be 17% almost at 3+. So why does price behave like this? Why does prices bounce at the support, and then why does prices go down at the resistance? By the way, for us in Investagrams, you don't have to be really precise with the support levels. Some people, they use supports that are really price specific. For example, I'd say the support of PPC is at 251, right? Super specific. But then we believe that you can actually use this and just implement ranges. So instead of saying 251, I just say 250 to 260, right? So that's what you call imperfect prices. Sometimes it's a textbook theory, but due to the uncertainty, we just focus on the ranges. Okay? So you don't have to be super strict saying that the resistance is at $3 or something. It can go 305, 310, depends on the behavior and depends on what happens in the stock. Okay? So why does the price bounce every time it hits support? So what happens here is that there's buyers at 260. The buyers are aggressive enough to stop the stock from going down. What does that mean? The demand is strong at that price level, 260. So for whatever reason, maybe they think that PPC is cheap at that level. There's a big buyer protecting PPC at that level. So it doesn't go below 260 because there's buying supporting that level. So basically, support represents demand. Okay? And on the other hand, just turn it opposite. Why does the price go down every time it hits the resistance point? So vice versa, there are sellers prowling at the resistance level. So for whatever reason, people want to sell PPC at this circumstance at 290 to 3. People are selling PPC. So perhaps on that price level, it's a bit expensive, or some sellers just want to sell at 3. So basically, the resistance level represents your supply. So that's where the sellers want to sell. All right? So it's a pretty basic concept. Again, just to iterate, support is your demand and resistance represents your supply. Okay? But then, what happens if the price goes out of the support and resistance? All right? So let's look for an example. By the way, besides these horizontal lines, you can also do the diagonal or slanted support and resistance like this. So oftentimes these are like your trend lines to give you a signification to show you how the trend is moving, right? So we're gonna discuss that in a separate video. Let's focus on horizontal support and resistance first. Okay, so let's look at a stock that has broken out of the support and resistance. Here, this is a pretty basic scenario. One of the strongest stocks this year. So we're looking at now. If you observe the price behavior before, it's holding at the 0.60 level and it bounces down, and the resistance at this point is at around 90 cents. Right? So for the support and resistance, you're just tracking significant highs and lows. All right? So you're observing the price behavior whenever the price nears a certain low or a certain high. Perhaps the nearest low and the nearest high. So here, excuse me. So here, we see that PPC bounces around 0.60 to 0.65. Okay? And on the other hand, it goes down every time it hits the 90 level. I guess in this case, it just went down one time. So on the second retry here, it's stalling a bit, but then you observe that, hey, prices are holding up around the resistance. So what does that mean? The buyers are becoming more aggressive, right? Instead of pushing prices back to 70 or 60 cents, the prices are now holding above 80 cents. And then on this candle, on this day, we see the price go above 0.90. What's the significance of that? So in this context, from November to around March, end of March, November to end of March, about 5 months, the prices were just moving in a trading range, dancing between the support and resistance. But on this day, it suddenly breaks out of 0.90. What does that mean? So remember this term, breakouts. All right. So now this is what happened. What happens when the stock goes above the resistance or breaks below the support? So on this case, it's a breakout upward. So a break of the support, we usually call it a breakdown. Okay, so there's a breakout at this level on this day. So what's the importance of breakouts? Here, I'll show you. So the importance of breakouts is this. So imagine if we bought at the breakout 0.92, 0.90, we get a 200% or more gain. So that's why some traders implement the strategy buying on breakouts. Why? Because breakouts often precede strong trends if successful. All right? So what happens in a breakout? So basically in the previous scenario, price is just bouncing off between the support and resistance, right? So there's like a balance. The stock is still finding the winner, so the stronger side. So it's just dancing around. So it bounces up every time it hits the support, and then it bounces down every time it hits the resistance. But then when one side wins, as we see here, when one side wins, so that's where the breakout happens. So what does that mean psychologically? It just means that the buyers are now more aggressive and thus beating out the previous resistance. Basically, they pushed the resistance away. They pushed the sellers away. They overpowered the resistance, the sellers, during that point in time. And because of that information, without knowing anything about the stock, we just knew that, hey, the demand is being more aggressive. It broke out of the previous selling level. So, in that information alone, we already get a precious insight about the behavior of now. So because the demand is now stronger, and if the breakout is really legitimate, and if there's really a reason for the buyers to continue buying, then it often leads to a trend, as we see here. So if we bought the breakout, you get 270% gain, or even a 200% gain is good enough, right? So this price movement happened from the breakout. That's just about 28 days of trading. Imagine that. Tripling your money in just 28 days. Wow. So if only we knew how to spot breakouts, we would really make lots of money out of this. But of course, you have to protect yourself. Risk management is the key. Breakouts don't always succeed. There are tons of circumstances where breakouts fail. All right, so I'll show you. Let's think of a stock that gives us whipsaws. So let's look for an example here. SM Prime. So just to illustrate, so you're tracking the previous high, right? Around 22, you see that 22 to 22.50, you see that it's the resistance for SM Prime. And then at this point, we see that prices goes above the resistance level, right? So if you were basing the resistance from the 22 to 2250, a close above two and a close at 2260 would mean a breakout for you, right? So you buy here thinking that, hey, it's a breakout, all in, baby. But then look what happens at the price. You get a fade. So it goes back down again to 20 and tries to go up again. So here's another try. That's the second try. But then it fades again. So this is a natural thing that happens in the stock market, you know? So sometimes stocks can get pretty volatile. And the concept of a breakout is just a textbook concept. That's why there isn't really a sure thing in the market. Now, even if you see a breakout, the price piercing above the resistance, you still have to implement your risk management. So if your strategy is a buy on breakout strategy, you have to implement a risk protocol. So when are you going to exit if in case the breakout fails, okay? So an example would be buying at you bought at 2260. So just to protect yourself, you're going to sell when it hits below 22. So that's what you call your cut loss point or stop loss point, okay? So this way, since we're buying the breakout, and if indeed the stock breaks out, right, it's supposed to continue moving upwards. If it's fake, it's gonna go down. So you don't want to be stuck on the notion na, oy, breakout na to bakit bumaba? And you're just gonna hold it. So oftentimes if you don't admit your mistakes, you're gonna waste opportunity costs and you're gonna lose money. But if we implement a stop loss, a cut loss level, so we bought at 2260, then we cut below 22. So how would that equate in terms of protection? We only lose 3%. So that's a good enough trade-off, because if the breakout is successful, you win a higher amount. But if the breakout fades, if the breakout fails, you only lose 3%, right? So in Investagrams, we really emphasize on risk management. You know, it's what keeps the best traders out there surviving, besides having the discipline and the strategy, all right? So there. Thank you for listening in our basic charting session. So just to review, we studied support and resistance and breakouts. All right. So what I showed you are just the basic illustration, basic ideas, and the psychology of what's happening in support and resistance plus breakouts. If you really want to understand it on a deeper level, you could just go research and find other resources out there. So, all right. Thank you for listening. See you guys again. This is Investagrams, your partner from start to profits. All right.